Welcome back to Alpha Bytes, the anonymous talk show where you listen to a couple of anonymous analysts give their best thoughts on what actually matters in the crypto space. This is Marconi Wight. This week I'm joined by TD, JJ, Ben, Lilly, Kodi, and Ray. We're going to be talking about a whole host of really interesting topics, everything from tokens and gold futures, looking at the terminal rate. But before I get there, I want to hear what everyone's thoughts are on what just happened over the weekend. We had the debt ceiling talks that apparently ended because, everyone was just completely surprised to see that the talks ended and we actually had an agreement. I want to hear from the team what they would actually say to McCarthy, the Speaker of the House, if they saw him in a coffee shop. Ben, as always, I'm going to kick it off to you. What would you actually like to say to Mr. McCarthy?
Can we just end the dog and pony show already and move on to the final act here?
Ooh, you want to you want to stop the kayfabe? You want to actually pretend or stop the pretending, huh?
Yeah, let's just move on. We all get it. You did your part. You did a little bit of a show. You got some talking points. Okay, let's move on now.
Move on. AJ, what are your thoughts?
Thanks for the pump. Ultimately, if there were actually any spending cuts in there, I don't think we would see risk assets and everything going up as it has the past couple of days. Might just be a short squeeze, but something tells me when you give a government unlimited budget, they're very inefficient at it. And that's what the market's telling us right now. Expect higher inflation.
Now, are you going to tell Mr. McCarthy, is that before or after you order your coffee? You're going to give him all that?
Well, I'll expand. Yeah, as the caffeine starts to hit the bloodstream, I'll really lean into those points a little bit more. Maybe hit him with some.
Do that. He's probably going to need an entire carafe of coffee at that point. TD, would you have something to say? Don't be shy, TD.
Sorry. I'm just thinking that. I'll probably tell him, stop crying wolf, right? Because this whole debt ceiling things, every time it happens, and every time gets resolved. So basically, just a lot of saber rattling, and similar to what kind of Ben was saying earlier. But also, I want to remind him that the ultimate ending of the story where the boys that cries wolf is that the wolf did come at the end of the story. So,
that's kind of a vicious visual I have in my mind. And Mr. McCarthy meeting up with a life-size wolf as he's trying to grab his latte. Ray, I think you're at a coffee shop. What would you like to say to Mr. McCarthy? Maybe he's there with you right now.
I wish. I would tell him good job, on the same vibes as when President George W. Bush let down the Mission Accomplished banner on the USS Abraham Lincoln aircraft carrier. And he gave a speech to troops commending them on their 6-week wrap-up of the Iraqi freedom mission. We all knew that there weren't going to be, we knew they weren't going to let the bottom fall out of this thing. And it was more about which party could claim a win, or which party actually stuck to its fiscal principles to convince their constituency. So it's political theater, but what I do wonder is, how did the market call their bluff, or the outcome that we're currently looking at in charts today?
All right. I love that.
Mission accomplished blend right there.
Mission accomplished blend. There we go.
We got the title, right?
We got the title. No,
irony of hubris.
That picture, that meme of Tom Cruise from Top Gun, sitting in the cockpit with thumbs up. I think we can probably swap his face with McCarthy's face.
Oh my God.
And we got another editor.
Yeah, that's right. That's going to be etched in my mind.
Let's hang it up. We're good.
Kodi, I know you've been tracking this nonstop from overseas. Everyone outside the U.S., I'm sure, is asking the same question. Please what would you ask Mr. McCarthy?
Have you ordered already? Because I don't know who you are, and I really need some coffee.
Oh. I'm going to, I think we're going to end it on that. That's the, I think that probably sums up what a lot of people are thinking around the world. We got the theater and we got who are you? All right, guys, let's move on to what's on your screener, because we got some really good topics. We got gold, we got target rates, we got money supply, we got DEXs, and then we got one specific Tokemak. I think this is going to be a really interesting discussion around the charts. If you haven't already, go to YouTube, subscribe, and like the channel. We're going to be giving out some of this information visually going forward. We're still trying to figure out some of these details. If you got questions or ideas, we'd love to hear from you. But today we're going to start off with JJ. JJ, I think you're talking about gold futures. Why don't you talk a little bit more about what's on your screener?
Yeah, that's right. What's good for gold is good for Bitcoin. So as I was saying, almost immediately after the debt ceiling agreement was reached, we saw Bitcoin pump, and then as soon as legacy futures opened, gold followed right behind, not surprisingly. And what we saw is gold bounced from the 100-day moving average at 1930. It's currently at 1960 and moving up. So this will be good for Bitcoin, I think, if it can recapture its trend, flip the RSI, get back over 2,000. It'll be clear skies ahead, back to all-time highs for gold, and I would expect Bitcoin to follow and re-break the 30,000 mark here over the course of June.
How does this chart kind of look from a risk aspect perspective? Do you see some? You just mentioned that what's good for gold could be good for Bitcoin. There's a lot of chatter that Bitcoin really is more of a risk-on asset. Gold is more of a safe haven. Are you suggesting you think that these are going to trade in tandem instead, kind of risk and safe haven same time?
Well, so I see Bitcoin as trading beta to gold, so it's basically a leveraged version of it, right? So when gold goes up, I think we could expect Bitcoin to outpace it. And when gold falls into a downtrend, you could expect Bitcoin to outpace it to the downside. So if gold goes, say, if it breaks back above its 50-day, takes out the highs there at around 2080, there's no resistance on this chart. It's going to enter into price discovery. We might even see 3,000 gold by the end of the year. Who knows? Like if it has that big of a breakout, it's been kind of in this range for about 3 years now. So a breakout from here could be really, like, it's hard to overstate how big of a move that could generate for gold. And that said, we saw what happened in 2020 after gold made new highs. Bitcoin followed behind it on a lag. Interestingly enough, summer of 2020, when gold broke out to new all-time highs, the NASDAQ did as well. So very similar to now. So we saw kind of all of these stocks that people were saying were overvalued, as NVIDIA is claimed to be today, but they were breaking out, and the NASDAQ was breaking out, and people were anxious to jump in front of it and shorted every opportunity. And there's a very similar thing going on right now where there's all this fear baked in. You know, the debt ceiling was a major fear. In 2020, it was, how's the economy ever going to recover from COVID?
Yeah, let me break in there.
People got run over.
So we were just talking about the theater of the debt ceiling kind of holding up the markets for a bit of time. I feel like it's been on the table for months at this point. How do you see the unwind now happening? You just looked at this chart. Is that a catalyst then? Is that going to provide some tailwinds for this trade for gold?
Yeah, you know what? This is becoming a really contrarian, setting up as a contrarian setup now, right? Is because everybody thought gold was bullish, because if you follow like the narrative, right, is that people would say gold was only bullish because people were pricing in risk of default. And if there was default, then obviously gold will go up. But reality is that gold just kind of follows liquidity, and for whatever reason, gold gets bid up, right? And liquidity is a major driver of that. So it could have been getting bid up for reasons totally unrelated to the debt ceiling. And now that everybody's expecting it to unwind, it had went back and retested the breakout, which is kind of structurally bullish. If it starts going up from here, I think that not many people will be positioned for that long trade. Same thing with Bitcoin, as people see it as a safe haven, but in reality, it's just reacting to positioning and liquidity dynamics. So I think continuation from here would catch a lot of people off sides and potentially force them to buy.
For those who are tuning in for a crypto show and they're asking why we're talking about gold, we like to talk about physical Bitcoin.
It's all downstream too, right? Like you see these things take shape in gold first, which would be a leader, gold, DXY, then it flows into Bitcoin. Then we see alts take off after Bitcoin goes up. So
got it.
It's just a leading indicator.
Well, yeah, very interested to see how this week unfolds with how the market digests the information from the debt ceiling agreement. All right, well, let's move on. Ben, you're up next. You've got an interesting chart. I think I commented on Twitter. It made me feel like we're on a roller coaster. You want to open up about that?
Yeah, and I apologize. It's not about crypto, but this is the sort of thing that can flow over, just as JJ mentioned, into the markets in due time. So just to start off, my chart is the probability of what the target rate will be by the Fed in December of this year. I've been watching it for quite a while now, but to sum it up in a line, rate expectations are changing it's moving the dollar, and we need to be aware of this silent move taking place in the market. So for context, we all anticipated that the Fed was done raising rates and likely cutting them this year. Even JP Morgan analysts were starting to call for it. They were expecting Q3 of this year, but looking at the probability chart, that's not the case. We have conflicting expectations in the market. And when there's widespread disagreement like this, that spells opportunity. Now, some of you on the call here might remember I was pointing out how much room there was for this change in expectation for these rates in the later half of this year. Specifically, when we look back a month ago at what the market thought rates would be after the December meeting, there was almost a 0% chance that rates would remain unchanged for the year. And not just that, the market was expecting rates to be 50 basis points less. Okay, so that's that big difference that I was alluding to. So I even thought there was going to be a 25 basis point cut by that time, but I didn't expect this line of thinking to be the consensus. And since it was, the Fed needed to make that change in the market, the change of expectations in order to keep their fight against inflation alive. So this need to shift expectations lined up nicely with the DYDX, the US dollar index. Several weeks ago, it was showing signs of strength, and this change in expectation with the rates, it acted as that nice catalyst for the dollar to make the run that we've seen over the last few weeks. And that's what I mean, that the silent force is influencing the dollar, and we need to be aware of it. So it's not the first time we saw it. We also saw it during the first week in February. Similar setup, expectations changed. DXY made a 4-week move higher, I think 5 weeks actually, but regardless, we just need to remember that timeline, February, March, Fed was pushing the throttle, trying to get those rate expectations really high. Everybody was saying it was too much, and what happened? SVB became global headline news across the world. So that was alluding to it going too far. So just real quick to sum it up, is this a coincidence that the Fed is creating these financial market conditions that scream for a need of liquidity just as the government is getting ready to raise the debt ceiling? I don't know, but that's literally why this is on my screener right now.
Okay, we're going to have to unpack quite a bit there. That was a lot of information to digest. I guess I'm curious from the rest of the team that's looking at for liquidity. You know, JJ, you talk a lot about the DXY. When you're looking at this chart, and you're looking at DXY relative to strength of BTC, how do you process this kind of relationship?
You could actually, I posted a chart on Twitter on Friday that showed the federal funds futures, which is basically the expectation of terminal rates over DXY. And you can see exactly what Ben was talking about, how DXY reacts as the terminal rate rises. So as the market thinks the rate's going to go higher, you see DXY move higher, which kind of sucks the air out of risk assets. What's interesting is, like, this is the lowest we've been now, as Ben pointed out, since March. So we're not at the terminal rate isn't as high as it was in March, but it's encroaching on it. Right now the terminal rate is 5.25%. In March, it got down to about 5.65%, which would be when they expect the Fed to stop hiking. And when it got higher than 5.5%, that's when you saw markets break. So what I'm kind of looking at here is, if we get to that 5.5% terminal rate again, do we have March round 2 where you just have markets collapse? And who knows what the catalyst will be this time. Last time it was, we found out they had all this risk on their balance sheets. Well, who knows what else is hiding?
I was going to say, so TD, when you think about what we just had in terms of the banking crisis, with some of these banks being shuttered, is that federal fund or that terminal rate starts to move up? Are you looking at some additional risks at a macro level?
I think there's several things that you have to be looking at without taking into further consideration of not just the rate itself, but just the entire ecosystem and the entire economy. I mean, obviously, with the rate going up, you're looking at everything that's in everyone's, I guess, mind currently, everyone's talking about is commercial real estate, right? And so that's one area to focus on. If the rate continues to rise, or even if it stays high, how much of these real estate companies or REITs, how many of them will be able to stay afloat, or will they be able to make the repayment, and what kind of default risk do they carry? And that's going to be another big time bomb, I think, that's ticking currently.
So TD, if you had to stack up the risk, would you put the REITs and the commercial real estate kind of at the top of the sheet?
That, and I think the second in order would be the commercial loans, the commercial credit market. I think that's something that people are looking at, and well, not a lot of people are looking at it yet, but I think that will probably catch a lot of people by surprise, especially as I mentioned previously. Pay attention closely to the credit default swap.
So it's a question of who needs debt, right? Whoever needs that debt, expect the rates to be a little bit lower. And now they're looking at it and like, not going to get it now. You're not going to get it.
And I believe last year, $1 trillion of commercial credits were lended out. And I think another trillion might be the year before. So now, whether it's short term or long term, regardless, when the rooster comes home, you have to figure out, okay, someone's got to pay up. So we'll see how much of that can get rolled over, or and if it doesn't get rolled over, then what's going to happen? That's, I think, when we'll see a lot more skeletons falling out.
Kind of jump in here just to ask TD something is, do we think it's going to not be that time deposit issue that we saw with the banks in March, and more about what you've been alluding to, which is just debt in the corporate market?
I think probably a bit more debt in the corporate market, because I feel that the deposit stuff that we've been witnessing, I think that's just the first shot. I think that there are more problems that's going to be behind it, and as these deposit runs out, and the banks are looking for, they cannot lend, and obviously tighter restrictions, and I think that you're going to have a lot of corporations that they just won't be able to find any people to lend to them, and so I think they're going to have issues. They're going to have a hard time finding cash to cash it to the operation expansion.
I was going to say, a couple of years ago, we had a lot of discussion about zombie companies that were just kind of floating around because they had access to cheap liquidity. If that dries up, we could see a different environment. Ray, I want to ask you, did you have something you wanted to say on that?
Yeah, so that's all pretty macro, isn't it? And what it sounds like to me is liquidity continuing to be sucked out of the system for those that will need it. And I mean, corporations and more than just retail borrowers, right? So what's the knock-on effect that has on crypto? Because everyone has been saying that, pivots in order by end of the year, by end of Q3 or end of Q4, and we should see more liquidity coming back into crypto. Hong Kong's opening up. So we should see more liquidity coming back into crypto, perhaps via China. But, with this debt ceiling kind of being resolved, that does not seem to be the case. That liquidity would just be free flowing again. So the two of you, what's your take on how that might impact crypto in the next 6 months?
So I think actually that kind of touches on the next point that TD has, because I know you're talking about money supply growth. So TD, do you want to touch on liquidity, or are you going to wrap that into what's on your screener?
Yeah, I think that'll be a perfect segue into the into what I've been looking at in terms of the chart that's really catching my eyes lately is the money supply growth, the M2 supply growth year over year. So the chart I'm looking at, it actually dates back back to I think 1850s, 1840s, all the way until present day. And so right now we're actually looking at a sharp and precipitous drop of the money supply growth year over year. And we're looking at a drop of negative 4%, excuse me. And the only 4 other times that the money supply growth actually dipped below zero. So one was the 1870s banking crisis. The other one is the panic of 1893, which is probably before our time. So we don't need to worry about that. But the next two is actually the Depression of 1921, which kind of was the aftermath of the World War One. And then the last time that it happened prior to present day is actually the Great Depression back in the 1930s. So whether this is actually, sorry.
Yeah, let me quick. Yeah, so when this is money supply growth, this is the U.S. census. So this is just the U.S. supply growth, money supply growth. Is that correct?
That is correct.
Okay, and for the audience that's listening offline, what's very interesting is he just showed this. It's actually kind of a terrifying chart if you look at it. But basically, from the 1940s to present, just until the last year, till 2020, everything is above the line at 0%. You just have these four anomalies. And that's very concerning in my mind, or at least it's something that should really stick out to everybody. So, TD, I think it's a great chart to bring to people's attention.
No, I think it's a compelling chart. Whether history repeats itself, we don't know, but I guess it often rhymes. So, that's old cliche. But I feel that it's something that, we have to kind of at least be in tune with and follow up and observe carefully. And regarding money supply, basically, with the banks lending and tightening down, and they're not going to be able to lend as freely as they did before, and the corporations and the individuals, they cannot afford the interest payment on their car loans, mortgage, what have you. So currently, you're looking at a very tight money situation where there's just not a whole lot of liquidity to go around. And it's fun. It's it's funny, but also ironic that I think a week or two ago when Powell said that the tightening credit conditions due to stress in the banking sector means that the central bank might not need to raise its policy rate as much as it would have otherwise to achieve its goal. So I think that's where the market gets the idea that, okay, well, Fed is probably going to pivot, right? Which I think we still have this misconception where pausing doesn't mean it's pivoting. It does not mean pivoting, and so don't confuse.
Yeah, let me jump in here real quick. I want to get to something that Ray mentioned, liquidity drying up. You just seem to reiterate that you don't see anything on this chart or the other data that would suggest we're going to see that coming at least from the United States Central Bank. What about on a global level? Are we going to see an offset of the United States liquidity coming from other jurisdictions?
That depends. There's a couple of charts I share. One of the articles I wrote before, and so technically, China is still pumping and they're still printing money left and right, and so is Japan. So now, will those liquidity be able to find its way onshore to the U.S.? That remains to be seen. And especially with Hong Kong, I know that we discussed earlier that Hong Kong currently opened up, and any Hong Kong PR citizen, as long as you have a banking account in Hong Kong, you can take your Hong Kong dollar and you can go to your local bank, or you can do it online, switch to any stable that you choose, and you can purchase any crypto. Well, I think there's 12 of them currently that's actually allowed for transaction in Hong Kong. But so basically, Hong Kong now is a free open market for crypto, and you can take USDC or USDT and swap out for Hong Kong dollars, and you can use that to swap out for USD. So could that be something where we might see some of the liquidity flowing out from China to the rest of the world? I believe that would be a very plausible case.
Yeah, I'm very curious because I recall a few years ago when China cracked down on all levels of crypto. Now they've opened it up in Hong Kong specifically. Do you have a take on, why that's happened? It seems counterintuitive for those who are not necessarily in understanding the mechanics of how that government may operate.
Well, I think part of it is that possibly and potentially that Chinese government figure out a way to regulate crypto. Which I doubt it, but I think the more credible reason here is that they actually finished their experiment with CBDC, and they're going to roll it out. And so I think that with CBDC rolling out in full force, it's easier for them to control the capital outflow of renminbi, which is the Chinese currency. So with that in their mind, so basically, I mean, they can probably sleep safer. I mean, sleep sounder at night, and so they don't have to worry about capital outflow issue. Now, I feel that they can allow Hong Kong to use Hong Kong as a proxy to open up and dump their liquidity and exit inflation that they have within China and to the rest of the world. Because technically speaking, they can just swap to Hong Kong dollar, and Hong Kong dollar, mind you, Hong Kong dollar is still pegged to US dollar.
Yeah.
Whereas renminbi is actually closed loop currency, so you cannot trade freely. But Hong Kong dollar is actually pegged to USD, so they can use that and offload whatever inflationary pressure they have within mainland China.
Yeah. So very interesting discussion. Obviously, I think for any of the listeners who are very crypto-centric asking, why does this matter? I think it's just going back to what Ray pointed out, which is, where's the liquidity? Is it leaving or is it entering the ecosystem? So these are kind of touch points or data points we can look at. But let's just for the sake of discussion, let's move on. We're going to come back to something very crypto-centric. Kodi, I want to see what's on your screener.
Well, finally, we have some solutions that will rival centralized exchanges when it comes to futures trading, and I'm quite excited about that. I think since FTX happened, FTX went down was kind of like a wake-up call for people. Everyone had in their minds like, yeah, not your keys, not your coins, but no one really kind of lived by it. Everyone was free to happy to punt in centralized exchanges, and I think that changed when FTX went down, and the market has been hungry for alternatives, for decentralized alternatives, and you can see that in a lot of protocols that have gained quite a bit of volume and popularity since then. But all these are smart contracts living on a chain, and those are not perfect solutions. Not to discredit what the builders have done there, but they inherit a lot of the constraints from the chain they are being built on. And so in my mind, the way forward is for this protocols that aim to be a decentralized exchange to basically build their own L1. And we finally have two of them that just released. One of them is Vega protocol. For now, it only has futures, so quarterlies and monthlies. And the other one is Hyperliquid. And this one has perps, which is the instrument of choice for most agents out there. And Vega feels a bit clunky still, but Hyperliquid is just so fun to use. It feels exactly like what the centralized exchange should feel like.
But Kodi, let me bring your questions. So we've got these two protocols. You said Vega and Hyperliquid. You think these are addressing the gaps in the market from a futures and options perspective?
Well, not options. It's just futures and perpetuals. So there's been a few protocols trying options, but they haven't found product market fit. But the ones going for perps have GMX, GNS, and whatnot. But these do not have order books. These rely on Oracle from third parties to get the prices from. They are usually exploitable. And as I said before, they rely on the constraints of Ethereum or whatever chain they are built on.
So let me jump in here and ask the question: how do market participants look at the gaps in the futures market? You have historically, I believe BitMEX, in my mind, is kind of the King Kong. I was there from the very beginning. Obviously, you've got other platforms that have opened up and offered some limited capability. The biggest constraint I've seen is really about access to individuals. So is this going to be moving? This is going to be post kind of AML KYC? Are we looking at a future where any individual, regardless of financial status, is able to trade on these? Are these still going to have some level of AML KYC?
Well, that's one of the reasons so many people want decentralized solutions, because they cannot access perpetuals trading or futures trading from like depending on the country they live in, right? Sort of retail is barred from using those. And once you have a good decentralized solution, I believe that you will not need KYC. Like some venues will need it, but I don't know. It's just as easy as forking the chain, and then you can have a chain that does demand KYC, and that will be a solution for those that want to play by the rules, and then there will be a solution for those that don't really want to play by the rules.
So this could effectively move beyond the constraints you have with jurisdictional AML KYC. What about some of the other challenges that people associate with low grade or poor performing platforms? You have pricing slippage. You have, I think you mentioned just the order books, thin order books, so you don't actually have enough liquidity. Do these protocols move beyond that with some new revolutionary type of breakthroughs in how they're actually delivering? Or is this
it's not such a revolution. It's just about building your own chain and designing specifically for an exchange, right? It's like if you're building on Ethereum or on another EVM or another similar chain, you will have very low TPS. You will have, like, you cannot mess with the block size. You are open to MEV. So like whenever I kind of try to do a trade, I will face slippage from MEV searchers. I will face front running, back running. They like the UX for users is terrible. Whereas if you have a chain that you've purposely built for that, you can get rid of most of these constraints. You can optimize for speed. You can, for like one of these, I know DYDX believes in having an off-book order chain. Off-chain order book. But Hyperliquid, for instance, has a fully on-chain order book, and I feel that it pokes a charm. Like obviously, it's a closed alpha, so there's not that many users just yet, but you can really feel like it feels like centralized exchange. I mean, when they get some kind of traction, I feel that those like thin order books will just be a thing of the past, and they will be, if not as good, close enough to what Binance Futures or some other like tier one exchanges feel like.
Wow, that's a bold statement and a bold vision. I'm excited to hear exactly where these go. So you mentioned one is it's still in alpha testing. Is that correct? Was that Vega or Hyperliquid?
Both of them are like they literally just released, and there's not many users. I think one of them is fully open, so anyone can use it. The second one, you need the code, but it's easy to get one if you know someone that is already using it. And it's like, the solution is not fully there yet, but I think we're getting there. And then of course there's DYDX, which they are up and running, and they are moving to their own chain based in Cosmos. So excited about that as well. Hope we get some news soon.
I'll jump in and just ask a quick question for you, Kodi. Have either of them mentioned any incentives to attract liquidity? Because that just becomes kind of the hardest issue to overcome, is all this fractured liquidity throughout the environment. But as an exchange starts to win over the market share of liquidity, then it acts as this positive feedback loop where its success breeds more success.
So I'm not aware of Vega having incentives just yet. I've seen some comments teasing on Twitter about like maybe some kind of drop, but the token is already out there. So I guess it's one, like if they do an airdrop, it's not going to be that big. The one solution that I find is interesting is Hyperliquid. So the team behind Hyperliquid is an HFT market makers thing. They have been quite successful in crypto. They decided to build the chain kind of like a side hustle. And what they are doing to incentivize liquidity is they have built a vault for the chain, which implements one of their market making strategies. And anyone can put their money in that vault and earn a yield on the money that their market making strategy does. So yeah, like that will give liquidity, and like the money that they are using to implement that strategy becomes from anyone that uses it. I think for now they have like 1.5 million TBL, which for like a closed mainnet, I think it's great, and it's later going up a little bit. And then they have released another vault, which is in charge of liquidations. So obviously, it's speculating once a position is liquidated, someone needs to take the other side of that trade, and you can also deposit money and benefit from that.
Is the strategy for the market maker detailed anywhere, or is this kind of closed source material?
I believe it's closed source. Otherwise, it would be easy to like pick, trade against it.
The skeptic in me is like, did you just design this to make a vault in order to leverage capital that's not yours?
Yeah, of course. Like, it's literally what it's made for.
Well, it is crypto. Let's not put it past people.
I don't think it's a secret. I don't think it's a skeptical view. I think it's what it is.
Right. So the incentives on that team to leverage other people's capital, where is there room for other market makers, other strategies, other uses of capital that is going to compete on the same protocol as everybody else? Like, those are questions that I would have as somebody that wants to build on something like that.
No, you can build your own, of course, chains. Like they have released a Python client, and I think others are soon to come. And then you can also build a vault. Like, if you have a market making strategy, you can also create a vault for it, and you will get some money. Like, everyone will get yield, and you will get an even bigger percent of the yield. And you're also, in a way, cannibalizing on other people's liquidity. I think it's a great way of bootstrapping an exchange.
Yeah, so it sounds like two very interesting projects. Interesting to see where they go from here. Ray, was there something you wanted to add?
Well, Kodi actually got to it. He answered it. I wanted to clarify, both of these platforms are layer 1, they're not layer 2.
Yeah, layer 1.
That's interesting. What's your take on that? Like, all the DEXs now are layer 2. So if they didn't take off right and see a lot of users, then wouldn't they run into the same sort of issues that platforms did in the past, which is untenable fees?
Well, you can build your chain in such a way that your fees are very low or almost negligible, right? Look at Solana. So I think that's what they're aiming for.
True.
Yeah, it's going to be interesting to see how they're able to get the incentive structure correct to get enough adoption, both at the liquidity level as well as the user level. Because I feel like with Solana, there was so much VC capital driving that adoption. If these are more side chain, side hustle projects, are they gonna miss out on that? But that's I guess time will tell. We'll have to come back to that one and definitely be a recurring topic here, just in terms of these new projects. But let's move on. Ray, what's on your screener this week?
Okay, so I put up a little chart showing this project called Tokemak, and my thoughts here is that Tokemak is walking in the same river twice. I don't know if that's a good thing, to be honest, but it still kind of piqued my attention. So let me kind of unravel all that. So Tokemak is entering the Ethereum liquid staking derivatives wars with a directed liquidity model and a liquidity management pool model that's kind of meant to auto-select and best. It's meant to kind of like select the best providers of ETH staking yield for those that are staking within the Tokemak platform. And the chart that I shared wasn't that impressive. It shows that Toke is a relatively low cap coin. It's not deeply liquid, except for at SushiSwap and Uniswap and Curve. But I'm not directly interested in just the token. I'm more so interested at the reason why this token did a 22% move today, which at the time of this recording, it has completely retraced, right? And it's like nearly always the case in crypto that token prices move on fresh announcements, proposals, mainnet upgrades, and so forth. But maybe this time it's different. So within this platform, the directed fee revenue and like directing fee revenue and capturing a percentage of protocol fees that was the base case for the DAO participation and the curve wars. If you remember from DeFi Summer and like DeFi 2.0, capturing yield and directing like the fees that you get from being a liquidity whale within Curve was meant to like allow DAOs to generate revenue that's then shared to people that are staking within that platform, right? So I'm sure all of you remember like VE tokens, right? And VE everything tokens. And of course, DeFi blew up and the Curve Wars descended into something which I would say was a stalemate. So I think that ETH LSD wars are probably the next multi-chain DeFi flywheel. And we already see Frax, Lido, and this new project even called Swell entering into this fracas. And whoever offers the highest yield, whether it's sustainable or not, is likely to become a magnet for staked ETH. And given that DAOs are the governance component of DeFi protocols, it's just a matter of time before DAO-focused ETH LSD platforms begin to spin up. So let's re-enter. Yeah? Am I talking too much?
Yeah, no, you dropped a lot of alpha bombs right there on this unsuspecting audience. Let me just rewind you a little bit here. So this caught your radar because of the price jump that usually goes off of news. That it's Century Trace, that's fine, but you're saying that there may be something going on here, and it sounds like you're developing a thesis for what may actually become, let's call it DeFi Summer 2. Or Summer 3, I guess. It depends on how you look at sort of how these things are coming. It sounds like you're looking at what may be a benefit in the next bull run. Is that a fair statement?
No, I do not think that it is a catalyst of the next bull run. I don't think that this is sustainable. I just don't think that the ETH liquid stake derivatives wars have reached, they haven't burnt out yet. They haven't reached the paramount point of euphoria and hit a level of unsustainability. So this is just this project did the exact same things during the Curve Wars. And this is a kind of a step in a new direction within ETH LSDs, but we've already seen this play out in the Curve Wars. So I think it's just a rotation for capital, and people that are there early might make a little bit of money, including this project, right?
Okay. So how are you looking at this? I guess from a data point, you're looking at some of the, obviously you've got some price action that kind of sparks your attention. What else are you looking at as you kind of monitor the situation to see how this is going to benefit from liquidity rotation, I guess, on a go-forward basis?
The project put out a new medium, and there's a few proposals in there, and one of them relates to the token mechanics for Toke, and it allows holders to stake tokens as collateral within liquidity management pools, and then they get fees from that like specific LNP. So it's meant to like incentivize stakers to back LNPs based off of their risk profile and their TVL. So, like a lot of DeFi governance projects have these a lot of DeFi like DAOs have these tokens that have no use, right? These governance tokens have no use. And what Tokemak is trying to do is give token utility within its ecosystem that's not connected to like the token's emissions or staking rewards that you get for staking Toke. And another thing that they're attempting to do, because you have like Lido, Frax, you have all these different groups that allow you to stake ETH and they're maximizing your ETH yield, but you're stuck within that ecosystem. They're attempting to kind of create an aggregator that auto places you in the ETH pool, which has the highest yield, and it auto balances, right? So if Frax is offering a higher yield this week, then you're in Frax, right? But then if somehow next week Lido is offering higher, you're in Lido. And I'm sure they'll have some sort of like fractionalized option where you can split between 2 or 3. And then from all this, it's meant to yield back fees to Toke stakers, which, if you look at all these Ethereum staking projects, most of them don't yield back any sort of value accrual to that actual governance token. And then this project aims to be multi-chain. So it started off as just Ethereum based. They've already said we're going to ZK Sync. We're going to We also plan to go to Arbitrum, and we will explore other ecosystems as they emerge. So it could be one of the first kind of like multi-chain Ethereum yield aggregators and auto LP platforms that also gives some yield or like supply side revenue back to toke stakers, right?
Yeah.
That's the whole thing. And this was a $35 token in the previous bull market, and right now it's a 74-cent token. So it could be the type of thing where if you get there early, you get to drink the cleanest water from the river. So
Right.
Is this sustainable? I don't think so, but it could be something that could balloon in TVL, and we see similar kind of, ballooning and token price for toke also. And it's unique in that I haven't seen a lot of other platforms yet try to do this regarding ETH LSDs.
Okay. So I guess from an audience perspective, this is a kind of a novel or close to novel. It sounds like a very ambitious project with some of what they're.
Early bird gets the worm, yeah.
Yeah. So thanks for bringing that to everyone's attention. Definitely something to keep an eye on for. Let's move on though, because we got the next segment up, and we always like to pick the brain of our resident Giga Chad brain, Kodi. We've got a couple of projects here. We really want to hear his thoughts on Pump It and Dump It. Kodi, are you ready?
Yes, sir.
Okay. Yeah. There we go. There's the excitement because sorry. All right. So Pump It or Dump It. Let's start off with Lybra's finances. TVL tripled over last week, circulating eUSD. Pump it or dump it?
Pump it. Not to pat myself on the back, but I will. Last week I highlighted Lybra as one very interesting stablecoin issue, and now it has tripled in TBL, and the market cap of its stablecoin has doubled.
So what I'm hearing, if people had just listened to Kodi all the time, they'd be a lot better off. So that was a pump it for some. I think you already mentioned that before. So everyone again, stay tuned. All right, let's move on to the next one. We got ADA Cardano, 50% of all-time highs TVL in USD terms, already well into all-time highs in ADA terms. Pump it or dump it?
Pump it. I think it's time to repent for all non-believers in Charles Hoskinson, the founder of Ethereum and Cardano.
Oh my gosh. Okay, I'm cutting that out. I'm making that go viral because Charles likes to, he always likes to tell people when people praise his project. So you're actually putting a pump on Cardano.
Yeah, and I think it might be a very interesting play because, as you can see, everyone hates Cardano. And what they are doing seems to be working for whatever reason. So I think it both has a working chain and some apps. I've tried it. It's quite simple and easy to use. And it has a lot of people behind it, like a lot of retail that really likes Cardano. So I think it might be an interesting container play in next bull market.
All right, guys, you heard it here. No hate, all love for Cardano. Let's move on to the next one. We got DYDX is moving to Cosmos. Is it eventually bullish for Atoms? Pump it or dump it?
Guess I have to dump it. I don't think it's bullish for Atom. I think nothing's bullish for Atom at this point.
Oh,
I think the B of Cosmos might succeed, but Atom itself, it looks more cooked by the day.
okay. All right, so we got
more broken hearts for Atom holders once again, year after year after year.
They must be used to it by now. I myself,
yes, I'm used to it. Us.
Yeah, me too. Like, I guess we're all masochistic.
Well, yeah, we love the pain. We are in crypto after all. So, all right, we got this next one. We got OpenEDEN's TBILL token with 24/7 fees. Pump it or dump it? This one's very odd. I want to hear pump it or dump it.
Pump it. I think this is a very good Trojan horse. Like, this is how you get the TradFi types hooked on crypto. They're going to get hooked on tokenizing, and then they're going to get hooked on everything else.
Am I the only one that finds it quite odd that they're offering T-bills on chain?
No. I want to get T-bills. I want to get yield.
Yeah, it doesn't surprise me at all.
Yeah.
People want 24/7 financialization of everything in a sense, and then they realize it's very tiresome. But initially they want it.
Yeah, and I also think that projects are looking to increase users, and they know that across the world, people who can't play with the U.S. financial system are looking for some sort of stability or a way to invest also. So offering this as a step or an attempt towards, I think, trying to capture some of that desire, some of that flow.
Well,
In a way, it's almost like opening up online broker accounts for kind of the internet. What was that, 94, 95? And right now, you have to go to Treasury Direct in order to play that game. And this really opens up something brand new for global
Exactly.
markets.
well,
Exactly. It's something our markets need to do already, right?
yeah. Well, I'm laughing because unfortunately JJ had to leave us. Otherwise, I'm going to be saying some stuff, and I'm not going to be punching at him when he's not around to defend himself. But this kind of flies in the face of the idea that the dollar is dying when they're opening up T-bills. And if you look at all the stables, they're all denominated in dollars. There's demand for dollars. But all right, well, let's keep the conversation rolling. We got one left here. This one comes from Caleb Franzen. He was noting there's Uni has a bewildering chart in 2023. It's down 3% of the year. And the question is, do we pump it or dump it?
We dump it. I think the market has finally gotten tired of worthless governance tokens.
Yeah.
And if you look at the good performance over the last few months, it's either tokens that give back yield to the holders or pure meme coins. Like DeFi tokens are mid-with tape right now.
Let's hold these tokens to a higher standard. And I'm glad I'm seeing this, to be honest.
All right. So there you have it. We got the pumps and dumps. We're done with Uni, and we're done, unfortunately, with Cosmos. We're going to pour out one for our homies on that one. But we got a couple of minutes left here. Let's move on to some topics. This actually came in from a couple of our audience members. There were some questions about BRC-20, and we had an internal conversation. There was a really interesting thread coming in from Trevor BTC. And I'm just going to read out what he put out on Twitter. He said, friendly PSA for the BRC-20 degens. Check yourself before you wreck yourself. Uniswap's open source indexer does not match API. Your balance may not be your balance. Do not use CEX, folks. That takes BRC-20 deposits. The last couple of weeks, conversations, we've been talking about BRC-20. This is really bringing up some interesting risks, I think, for the ecosystem, because if I'm not mistaken, Bitcoin is now the largest location for NFTs after Ethereum, which means it's a dangerous place if it's not structured correctly. So I'm curious what you guys think about this. How you're looking at the risk here and the growth of BRC-20.
That's a hard one because the upside is tremendous, right? We are really early innings of a brand new trend, and the risk is clear as day. Like, you literally might be acquiring an asset that was sold by someone who doesn't even own the asset. And that's kind of what he's alluding to there, is the indexers might not be reporting who holds what. So when you actually go ahead and do a transaction, it's not clear. And this alludes to the tech stack just not quite being ready for some of this financial innovation that wants to take root there and will. I mean, when it comes to centralized exchanges, like how are they gonna do this? I know Binance is looking at it, and it's gonna be an interesting solution, whatever they come up with. But I don't think this is the last time we're gonna hear about this.
I think there's always a profit to be made. I think people take their chances. So I mean, it's really just. I mean, great, awesome for the PSA, but I think that you're going to have people saying, well, just take a gamble. See how it goes.
Yeah, I guess I'm curious, what do you guys think of the reputational risk for Bitcoin? Because, in its entire lifespan, all of the proponents of it are going to tell you it's never been hacked. All the hacks and all the issues have always been because of centralized exchanges. Now we're going to have a massive amount of NFTs sitting here. It sounds like, again, it could be on the periphery. But if this something blows up and you start to see the shenanigans reach epic proportions, is there going to be blowback on Bitcoin?
I don't think so. I think as long as there's still that 21 million narrative, I don't think it's going to, I doubt there'll be a blowback.
Yeah,
Kodi, what were you saying?
I was just going to agree and say it would be a blowback against the exchanges. I think at any exchange that has ordinal for now, you need to treat it as a package shop. Like you're just punting on price, but you don't actually are trading the underlying. And an easy solution for exchanges would be to just offer perpetual markets on this, so that they don't. What's that, Ben?
No, that's a good point. I didn't think of that. I'll let you finish your thought before I add something.
Actually, it's not in my brain anymore. I don't know what I was going with it, but yeah, I think you don't have to mess with having the ordinals themselves, and you just offer futures on the other line, so you don't have this kind of risk. And the retail, like the users, also don't have the risk of not having what they think they have.
True. And I want to hit on one point because I'm noticing this really divergence within the Bitcoin community. And I think Nick Carter is sitting like right at the middle of this divide, which is, this is innovative tooling in a sense, whether you agree with it or disagree, like this is something new. And there are builders that are trying to build new products, new services onto this L1. And if something happens here with BRC-20s that ends up kind of resulting in a lot of people pointing their finger at these builders and laughing, like that's going to be very harmful. And it's going to be a little bit sad to see, but it's probably going to happen at some point. And I hope that those builders do get the support that they're going to need to essentially get through the laser eyes, if you will, which is kind of the other side of the camp that I think the two are really butting heads with.
I'm very interested to see how this continues to evolve. As you mentioned, you have the laser eyes, traditional, I think what we would mostly be called Bitcoin maxis that are continually pushing one narrative. They don't want to see, they consider a lot of this activity to be spam. And
I think Bitcoin maxis are a dying breed.
Yeah.
Yeah.
Yeah, I mean, but also back to Kodi's point earlier, which point that I'm trying to make also is the fact that, saying that, well, Bitcoin, ruin reputation is like saying that, well, I mean, pencil doesn't misspell words, right? It's the person that actually uses the pencil to write, maybe needs to, work on the spellings a little bit. But so I think overall, I honestly think there's, regardless, all these kind of, attempt to try to get some utilization or trying to make something that, that for Bitcoin in terms of, building apps or stuff like that on it, I think it's actually good, to be honest. I think it's probably better for Bitcoin overall. So
yes, let me ask. I want to ask a question. So if we think that this is going to minimize the Bitcoin Maxi, the laser eyes, does it embolden the side chain, drive chain? I use those interchangeably without the technical distinction. Does it embolden that faction of people that are trying to continue to add functionality, not directly onto Bitcoin, but on the, using that kind of capability? Because I believe this all came in.
I think so. I do think so. That's the ultimate outcome of ordinal inscriptions in BRC-20, I think, is that we see it makes network transactions expensive. It clogs up the network a little bit, and it will push more liquidity onto the Lightning Network, and it'll push more innovation into building those kind of like off-chain Bitcoin dApps that if they get liquidity, and as Bitcoin becomes denominated in Satoshis in media headlines and like among people when Bitcoin's in the future, perhaps holding a 60, 70, 80 or 100K floor, and it doesn't deviate from that. And then people start talking about Satoshis because they're more affordable. They have the perception of being more affordable than one actual Bitcoin, then there will be a lot more reason for people to hop onto the Lightning Network and build things there, and lower transaction costs will be one of those. So the only issue with it right now is there's just not a lot of liquidity on all the channels there. But I think that BRC-20 is the catalyst, or at least one of the catalysts that's kicking off that eventual migration there. And then you'll have just Bitcoin itself as a instrument, a commodity, a store of value, something that you trade, a medium of exchange for some, a collateralization asset for others. But I think that's the direction we're going in. I mean, that's where we need to go.
All right. Well, we've got just a couple of seconds here. Any parting thoughts from the rest of the team?
I just think it's great. I want to see more capital start flowing into these projects. I think there's a little hesitation on whether this trend is for real or not. And once there's affirmation that it is, we'll see the capital come in. We've had a lot of projects that kind of worked on the L2 sidechain for quite a while and has really earned the bulk of all the capital coming in. But now if capital starts flowing, those projects will get fresh injections and hopefully new projects as well that can compete.
Right.
Diversity is the best thing to have when it comes to innovation.
I think that is a perfect note to end on right there. Thank you for everyone for joining in. I want to thank TD. I want to thank Ben, Lilly, Kodi, Ray, and JJ. Thanks for joining me this week. That's going to wrap it up. If you haven't already, we'd love for you to subscribe, like the episode. Let us know what you're interested in. Several of the topics we talked about today actually came directly from you guys. You guys are the winter market warriors, and we want to be providing the best information we can to all of you out there. Yeah, if you haven't already, go check us out on YouTube, and you can find us on Twitter. We'll link all the handles down in the description. Go check us out, and we'd love to hear from you. And until next week, be careful, be well in this crazy world of crypto. Take care, and we'll talk soon.